Right, so I see a potential long trade on dollar yen M15 candles, and you can see it's on a clear uptrend, right? With the 6 above the 18 EMA, above the 50, above the 200, clear uptrend, and this is an impulse pullback setup. You can see the 6 EMA crossing above the 18 EMA. So this is the swing high, and this is the inside bar, right? Making a lower high and higher low. So I should have entered this trade above the high of this inside bar, right? But again, I was late. I just woke up. Okay, so now that I'm looking at it, it's already formed 1, 2, 3 candles, right? So I'm a bit late to the party, but it's still a valid trade because now this trade should have been triggered, as you can see. I should be in the trade now um, with the entry price there, my stop loss 8 pips below. But I can still get into this trade, no worries, right? Because it's still a valid trade, so I can still get in. So I'm going to place my buy order above the high of this candle as was intended, right? Because it could still go back up. Let me see. So my buy order would be at 112.88. All right. And my stop loss would be usually below the low of this candle or 8 pips away, whichever is further, right? So 112.88, 8 pips away is 112.80. So we're going to put it 112.80. There we go. All right, so that is our stop loss. It's our profit target, and we are 8 pips away. So our profit target must be 12 pips away. So let's calculate how many lots to trade for this guy. So say our account size is 5,002, risking 2%, stop loss is 8 pips away. And this is the dollar yen trade. So based on this, we will long 1.46 lots. That's 146,000. So we're going to put a new order. Whoa, okay. This screen is strange, okay. So 1.46 is the volume. I'm going to use a buy stop limit order, pending order. Buy stop, which means buy above that price that we want. And what's the price? 112.81. So 112.81. Stop loss at 112.8. Sorry, our stop loss is 112.80. Our entry price is 112.88. That's right. And our take profit would be 12 pips above 112.88. So it's 113. That's right, 113. Right? So place the order. That's right. So order's in, and let's see what happens. So we're going to enter a buy over there, stop loss over there, and profit target will be there we go. So buy order over here, stop loss over here, profit target over here. Let's see if it gets triggered. If it does, it will hit our target profit or our stop loss order. So we'll just have to wait and see and come back to this trade when it's done. Okay, so coming to revisit our trade that we placed earlier on, right? And you can see that it has hit its TP, profit target. Let's take a look. So earlier on, we placed the trade at 112.88, if you recall, and stop loss at 112.80, and our profit target was 113. So I left it. I went to do something else, and I came back, and I saw that the market moved sideways, and eventually got triggered over here. You can see the price got triggered over here at 112.88, right? So again, we should have actually entered the trade over here after the swing high and the inside bar, right? But as you recall, by the time I looked at it, the price had already moved here. So I placed my buy stop order at 1128, and so it was there, and it only got triggered a couple of candles later. Okay, now as long as the price remains above the 50 moving average and the 6 EMA is above the 18 EMA, it's still a valid trade, right? So if the 6 had crossed below the 18 or crossed below the 50 moving average, I would cancel the order, but it was still a valid trade. So I kept the order there, and it triggered over here, and it hit the profit target at 113, 123. You can see 3 candles later, it hit the profit target. So this was another winning trade that I clocked up. Okay, so that concludes this example of how I place a trade for a long setup for the impulse pullback. All right, so there's a potential trade coming up on dollar CAD. Again, I'm looking at M15 candles. This is an impulse pullback trade. You can see 6 EMA crossing below 18 EMA, and it's below the 50 moving average, and it's below the 200 moving average, right? So it's a clear downtrend. So I'm looking to take a short. This is the swing low candle, as you can see, right at the cross. So this is an inside bar. It's still forming, so it's 541. I have to wait for 545 for the candle to close to confirm a trade, but I can begin to prepare my settings, right? So it's dollar CAD, so I'm going to size my position first. First thing I'm going to do is to check my current balance in this particular account. So I'm going to go to view, terminal, and current balance is 5199. That's the equity. That's the amount of cash in this account. So I'm going to put go to this position sizing calculator. You can use any calculator on any website. So account size 5002 is about there. I'm going to risk 2% on this trade, and let's check it out. So I gotta wait for this candle to close, and I'm gonna put my entry right below the low of this candle, right? So my entry could be somewhere here. That would be 2467. Okay, and my stop loss would usually be above the high of this candle, but it must be at least 8 pips. So 2467 plus 8 is, just to work it out, 2467 plus 8, that'll be 2475. So my stop loss has to be at least 2475, which is, there we go. All right, so that's my stop loss, 2475, target price 246. Entry price 2467. Okay, so that's 8 pips. So if my stop loss is 8 pips away, I'm going to put 8 pips here, and it's a dollar CAD. I'm going to select dollar CAD and calculate. So you can see that if my stop loss is 8 pips away, I'm risking 2% of 5,002. I have to buy 1.62 lots, or 162,000 US dollars worth. So 1.62 lots. I can get ready my order. I'm going to click trade. Okay. new order. So volume will be 1.62. All right, and I'm gonna market execution means enter the market price. I don't like that. I'm gonna use a pending order, which is a sell stop, because I'm gonna sell the moment it hits the entry price, which is the stop price. Okay, so my sell stop is gonna be at below the low of this candle. You can see now this candle is gone beyond that, so I have to now adjust it. It's actually 545, so 2467. So my price is 2467, 1.2467. Okay, and stop loss at 2475. 1.2475. Now I can place my trade first, and my take profit I can do it later. I'll place my trade. Oops. I gotta do that again. Damn. So now we can see the price is 2467. So 1.2467. Stop loss 2475. My take profit, I'm just gonna put it at 1.2400 for now. I'm gonna change it later on. I'm gonna place my trade. There we go. So my trade is in. All right. So my entry will be 2467. Stop loss 2475. Now, bear in mind that my target price has to be 1.5 times away. So my stop loss is 8 pips. So my target price has to be 8 times 1.5, be 12 pips below the entry price. Okay, so I'm going to set it. So my entry is 2467 minus 12. So target price would be 2455. There we go. So I'm going to modify this order to 2455. There we go. So my order is in, and you can see I'm in the trade right now. Okay, I've already sold it at 2467. My stop loss is 2475. Take profit 2455. And as it goes down, you can see my profit will be positive. Currently, it's not gone down yet, so it's still a negative unrealized profit. If I zoom out, you can have a better look. This is my entry, my stop loss, and my target price. So if it hits the target price, I get 1.5 R. If I hit the stop loss, I minus 1 R. Okay. I can just draw it for you so you get a better idea what I'm talking about. Oops. So there we go. I just entered here. My entry price was here. Okay, stop loss is here. So my stop loss 8 pips away. 8 pips. So that is 1 R risk. And my target price is way below there at 1.5 R, below the entry price, which is 12 pips away. All right, you can't see it because it's below the screen, but it's over there. All right, so there we go. So we're in the trade, and we shall see whether it turns out to be a winning trade. Okay. So again, when you enter a trade, you have no idea which one's going to win, which one's going to lose. But as long as you take the high probability trades where we are selling on a downtrend and going long on an uptrend, you can be sure that you're going to have more wins than losses. Your average win is going to be more than your average loss, right? So I'm going to leave the trade, and I'm going to check on it after a while to see where it goes, right? Currently, you can see the price now coming down slowly, right? Slowly, and the more it goes down, you can see the profit would start to turn positive as it goes down to my target price. So as you can see, the trade is going in our direction, right? It's going down towards our target price. Currently, we have got $40 in profit, all right, unrealized profit, and we have to hit our target price to exit to realize the profit, right? All right, as you can see, our trade is doing pretty well. We're almost hitting our target price of 2454. Current profit is $107, unrealized profit. We're almost there. Just give it a couple of seconds or minutes, we should hit our target price and we score another win for this trade. All right, so as you can see, the price has just hit our target price. So you can see it's highlighted TP. All right, and maximum profit $145 out of $5,100 that we started with just now. So our equity has grown from $5,100 to $5,335. So that represents a 4% increase in our equity, right? Because we risked, we risked 2% and we're up 3% on our equity for one trade. So that concludes our example of how we use the impulse pullback strategy, and this is for a short trade. Hi, welcome to this lesson on selecting high probability impulse pullback trades. This is Adam Koo and I'm your trading coach. So you've learned about how to trade the impulse pullback setup, and you'll be getting these trade alerts daily on potential impulse pullback trades. Now, out of all the alerts that you get, not all of them could be high probability. So I'm going to show you the ones which I tend to pick, which give me the highest win rate for this trading system. So in selecting the highest probability impulse pullback trades, I look for two things. Number one, I like to ensure that the inside bar or the pullback prior to my entry is a pin bar. So obviously if I'm going long, it should be a bullish pin bar. If I'm going short, it should be a bearish pin bar. So again, do review the lesson on how you define a pin bar. Basically, a pin bar, a bullish pin bar is one where you have a small body, candle has a small body, and a long lower shadow. So this is a bullish pin bar. Now the color of the candle doesn't matter. Okay, so it could be a red candle or a green candle. The reason is because the body is so small that the color is irrelevant. Okay, so bullish pin bar is you must have a small body with a long lower shadow. And ideally, the lower shadow should be at least 2/3. The length of the lower shadow should be 2/3 of the entire range of the candle. So if you take the entire range, which is 3 out of 3, the lower shadow should be 2 out of 3. Okay. For bearish pin bar, it's the opposite. So bearish pin bar is one with a small candle body and a long upper shadow. So similarly, the upper shadow should be 2/3 of the range of the candle, and the candle color doesn't matter. Okay, so now that you understand or you know what a pin bar is, so for an impulse pullback to have the highest probability, I want to ensure that the inside bar or the pullback prior to entry is a pin bar, a bullish pin bar if I'm going long, a bearish pin bar if I'm going short. In addition, I would also like to see that the inside bar or the pullback prior to the entry is finding some kind of support at one of the moving averages, either the 6 or 18 exponential moving average. So let's take a look right now. So over here you can see this is the first example of a long impulse pullback trade. So we have got this is the 6 EMA and that's the 18 EMA. All right, so the 6 crossing above the 18 EMA is the signal, and right at or right after the cross we have the swing high. So again, this is the swing high candle. Okay, so again, right after the swing high we need to have either an inside bar or pullback candle. So in this case we have an inside bar candle. So why is this an inside bar? Because again, it's making a lower high and a higher low relative to the swing high candle. So this is an inside bar. Now, whenever I have an inside bar by itself, I must have it touching one of the moving averages, the 6 or the 18 EMA. If it's not touching any of the moving averages, I tend not to take those trades. So in this case, you can see it's touching, and it's a pin bar, right? It's a bullish pin bar. So the moment I see that, I can proceed to put my buy order, right? My buy stop order right above the high of the candle, right? That's my entry price, and my stop loss right below the low of the candle. And again, the distance, as usual, has to be at least 8 pips. A minimum of 8 pips. If it's not 8 pips, I have to shift the stop loss down until I get at least 8 pips. Okay. So the first example is one where you just have an inside bar before you enter the trade. So again, it's going to be a bullish pin bar. So let's take a look at another example of how this setup works. So again, we've got a 6 EMA crossing above the 18 EMA. We've got a swing high. Okay, so in this case, right after the swing high, we have a pullback candle. So why is this called a pullback candle again? Because it makes a lower high and a lower low. So this is a pullback candle. And again, it's a pin bar, right? So I always want a pin bar to appear before I enter. So in this case, once again, I place my entry above the high of that pin bar and my stop loss at the low of the pin bar. Okay, let's take a look at another example. So these are all possible combinations of setups that could appear. Okay, so in this case, again, 6 crossing above the 18 EMA, right at or right after the cross, we've got a swing high candle. Now in this case, what happens? After the swing high candle, the next candle is an inside bar, right? Makes a lower high and a higher low. So this is an inside bar candle. So right when after this inside bar closes, can we enter the trade? Well, it's not a high probability. Why? Because the inside bar is not a pin bar looking candle and it's not touching the moving averages. So I would wait to see if the next candle makes a pin bar. Obviously, if the next candle makes a higher high, then this inside bar is no longer a valid trade. All right. The next candle has to be another inside bar or pullback. So in this case, what happens? After the inside bar, we have a pullback candle, right? That makes a lower high and lower low, and this time it is a pin bar. So we can now enter the trade because it's a high probability trade. So I place my buy order over there, entry, and my stop loss right below the low of this candle. All right, so that's what I'm looking for. Now let's take a look at a short example. So the last example is a short example where this time the 6 EMA, which is the red line, crosses below the 18 EMA. So that's our downtrend signal. And again, right at the cross, we have a swing high candle. Swing high. And right after the swing high, we need to have an inside bar or pullback candle for it to be a valid pullback, right? So in this case, it's a pullback. Makes a higher low and higher high. So there's a pullback candle. And this pullback candle, again, happens to be a pin bar, right? So again, pin bars give you the highest probability. So once that candle closes, I place my entry price right there at the low of the candle and my stop loss at the high of the candle. Again, assuring that I've got at least an 8 pip stop loss distance. Okay, so do understand this concept. If you're still not 100% clear, feel free to email me with your questions or with the charts that you're trading, and we are happy to take a look at it. Okay, so let's take a look at all the high probability impulse pullback setups that happened in February, which was the month that just passed. So the first one appeared on the 2nd of February. That's the long trade on Canadian yen. So let's take a look at the setup, right? So over here, you've got the 6 EMA crossing above the 18 EMA. Again, the red dotted line is the 6 EMA. The blue dotted line is the 18 EMA, right? So right after the cross, we have this candle, which is the swing high candle, right? So there's a swing high candle. And right after the swing high candle, we have got a pullback candle, right? That makes a lower high and a lower low. So again, this pullback candle happens to be a pin bar, right? Because it's got a small body and a long lower shadow. So we can enter this trade. So the buy order would be just above the high of this candle, in this case 89.09. The stop loss just below the low of the candle, 88.96. So the distance is 13 pips, which is more than 8 pips. So remember that it's got to be 8 pips or more. So 1R is 13 pips. Our profit target will be 20 pips away, which will be at 89.29. So the next candle, it went up, triggered the buy order over here, went up, almost hit our profit target, came down, went up, and boom, hit the profit target over here. So you can see that sometimes it could almost hit the profit target and come back down, and you got to just let the trade be and not intervene and let it do what it needs to do. Okay, here's another one. This is 2nd February as well, long on Euro Yen. Again, you can see the 6 crossing above the 18 EMA. All right, so this is a swing high candle. Right after the swing high, we have an inside bar candle. All right, there's an inside bar, lower high and higher low. So again, if you only have an inside bar candle, it must test the moving averages. And again, it's a pin bar, right? So pin bar gives you the best probability. So once we see a pin bar, we again place our buy order right above the high of the candle. In this case, 13687. Our stop loss right below the low of the candle, in this case, 13678. And our stop loss distance is 9 pips, which is at least 8 pips or more, so that's fine. Our profit target is 14 pips, so you can see it hit our profit target as well. Next trade is Pound New Zealand. It's a short trade on 6th of February. So this was a 6 EMA crossing below the 18 EMA. This is a swing low candle. Okay, so right after the swing low candle, we have got an inside bar candle. So this is an inside bar. So could we have placed the trade after this inside bar has closed? No, because you can see that this is not really a bearish pin bar. A bearish pin bar should have a smaller body and a long upper shadow. In this case, the body was 50% of the candle range. So that is not a high probability trade. Okay, so the next candle was another inside bar. And this inside bar now is a pin bar, right? It's got a small body with a long upper shadow. So we can place our entry price. So again, our entry price is over here at 9120. Our stop loss is right above the high at 9153. In this case, our stop loss is 33 pips. Our profit target is 50 pips away. And you can see it hit the profit target as well. Next one, 6th of February, short pound dollar. Again, you can see the 6 crossing below the 18 EMA. Right after the cross, we've got a swing low candle over there. Right after the swing low candle, we have an inside bar. Okay, inside bar candle. And again, this inside bar candle is a long upper shadow. Okay, I know the body's a bit big, so this is a bit of an iffy. So if you did not take this trade, that's fine. I happen to take it because I like the long upper shadow that is, again, finding resistance at the moving average. So again, remember, whenever you have an inside bar or pullback, it's always good if it tests the moving average that shows a resistance. Okay, so the entry price again is below here, stop loss is there. The next candle was a doji, did not trigger the order. Next candle triggered the order and it hit our profit target. Next one is again a short trade on Aussie dollar on the 8th of February. Again, you can see the 6 crossing below the 18. This is the swing low candle over here. Right after the swing low candle, we have got a pullback candle, which again looks like a pin bar, right? Small body, long upper shadow. So again, Our entry price is below the candle, 7816. Stop loss at 7824. This is exactly 8 pips. Profit target at 7804. 12 pips away. You can see right after we place the order, the next candle triggered and we hit our profit target again. Next trade, short Aussie CAD, 9 of February. You can see again 6 crossing below 18. That's a swing low candle. Right after the swing low, we've got an inside bar. Again, inside bar is testing the moving average. It's a pin bar, right? Small body, long upper shadow. So we place our entry price right below the candle, 9810. Stop loss right above the high, 8 pips away, 9818. Profit target at 9798. And again, very nicely, the next candle triggers our sell order and hits our profit target. Next trade, long pound Aussie, 9 of February. So as I'm showing you all these trades, I hope you understand the pattern I'm looking for, right? So again, you could get a lot of these trade signals every day. You could get like, 5 or 6 trade signals a day, and there are many days that I only take one signal, or I don't take any signals because I only take the ones with the highest probability, which are the ones which, again, the inside bar, the pullback candle is a pin bar, and ideally it tests the moving average. Okay, so again, one more, 6 crossing above 18 EMA over there. That's the swing high candle. Right after the swing high, we've got, again, an inside bar, which is a pin bar, right? So again, our buy order is 7914, stop loss 7904. In this case, it's 10 pips stop loss. Profit target 15 pips away at 7929. Hits our profit target in 1, 2, 3 candles. Okay, next 9 of February. Sorry, this is a wrong one. Next one is short franc yen, 14 of February. Okay, so in this case, let's take a look. 6 crossing below 18. Right after the cross, we've got a swing low candle. Right, there's a swing low candle. And right after the swing low, we have got an inside bar. Can you see this inside bar? So, after this inside bar closes, will we take the trade? I wouldn't take the trade because, again, it's not high probability. Why? Because this inside bar is not a bearish pin bar. Number one. Number two, you can see that it is not testing or is not finding resistance at the moving averages. So it is not a high probability trade. So I wait for the next candle to appear to see if it's a better candle. So the next candle that appears, again, it's another pullback. And it happens to, again, be a pin bar, right, with a long upper shadow, okay? And it's testing the moving averages. So there's a high probability trade. So we can place our entry order, again, right below the low of the candle, 115.19. Stop loss, 8 pips above, 115.27. Profit target, 12 pips below, 115.07. So you can see it very nicely hit our stop loss, hit our entry price and hit our profit target within 4 candles. Next one, 19th of February, short pound New Zealand. Again, 6 crossing below 18 EMA. That's a swing low candle. Right after that, we have got our inside bar. Inside bar is a pin bar, bearish pin bar, long upper shadow, small body, testing the moving average. Okay, so again, entry price below the candle, stop loss above the candle, 9 pips stop loss distance, profit target 14 pips away. Hits our profit target in 1, 2, 3, 4 candles. Next one, 21st of February, New Zealand Canadian dollar, long trade. So 6 crossing 18 over here. Right after the cross, we've got this big swing high candle. Very nice, okay? And right after that, we've got a pin bar, right? So that is a inside bar, which is a pin bar candle, okay? Now, let me just say that this is half a high probability trade, Why? Because it is a pin bar, yes, but it does not test the moving average. Okay, so if you would give this trade a miss, that's fine. Okay, in fact, I did not take this trade. I didn't take this trade, but one of my students took the trade, so I thought I'd put it in. It did happen to hit the profit target as well, right? But again, I did not take the trade because I like the inside bar to test the moving average support. In this case, it did not. I did not take the trade. My student did. So if you miss this trade, that's fine as well. Okay. Next, short dollar yen, 21st of February. There we go, 6 crossing below the 18 EMA. This is our swing low candle, this big red candle over there. And right after this candle, we've got an inside bar. Again, is this a high probability trade? No, because it is not a bearish pin bar. Okay, it is a doji because the upper and lower shadows are about the same length. Okay, so the next candle is a pin bar looking candle. It's a pullback. We can take the trade. So sure enough, we take the trade and we hit our profit target again. Okay, last one. Short Euro USD 24th of February. So that's a 6 crossing below the 18 EMA. And we have got a swing low candle. Right, there's a swing low candle. Right after the swing low, we have got a pullback, which looks, again, very nice bearish pin bar candle. Okay, so we place our entry, stop loss, profit target, and again, it hits our profit target very nicely. So I hope you understand the concept. Again, if you don't, please watch the video again and again until you get it. Please send me an email if you've got questions, and I'll be more than happy to review your trades. You could do a screenshot of the trades you're doing and say, Adam, can you double check, was this a high probability trade? Because I know if you follow these rules, you'll get a really high win rate for this strategy. In fact, this is one of my favorite strategies to trade, giving me very consistent profits every single month. All right, so it's Adam Koo signing off, and I'll see you in the next lesson.